All right, we're just gonna do a raw charting session. I'm just gonna show you guys how I view the market as a 6-year, six-figure trader. Okay, because the way I used to view it was just completely different. Like how many, like you guys watching, you probably just like look at this and be like, you automatically see things. You automatically see like a head and shoulders or a bull flag or supply demand zones or something like that. And the way that I just view the market and look at things like time frame and just price action is so much different than when I did when I first started. And I just want to share with you guys like how I look at things, because it's completely different, and I want to be able to put my mind on like a video or on a chart so you guys can just see like what I look at. And the reason all of this even started, literally, because I had an account. I put $1,000 in this MetaTrader account, AMP futures account, and I just wanted to try trading based off intuition, which is something that I don't recommend to anyone. Okay, what I actually trade is with an edge, with a strategy, is set by set like rules of like get in when this happens. But I'm like, I've been trading 6 years. I feel like I know what price is gonna do, and not like in some ego thing, like not like I'm gonna be right 100% of the time. But like you just know, like I just see that, like I just know what most of the time what's gonna happen, and I tend to be right. And there's a lot of situations where I'm like, I think price is gonna go higher, but I'm not gonna buy because it's not my strategy, and then price goes higher. And so I'm like, let me just throw some money in an account, try trading based off tuition, and I turned 1,000 and 2,300 a little bit over a month, just scalping one thing, MNQ futures, and it was honestly really freaking easy. So I want to show you guys. Putting my mind on paper, I wrote some things like how I view the market, low volume nodes, retracement sizes, speed, stop hunts, retail theory, and we're just going to dive in, all right? And if you guys fuck with the shit, like if you guys like the video, just share it with someone, all right? I don't actually set it, typically at the end, I'm like, all right, if you guys enjoy the video, like, subscribe, like screw that. Just share the freaking video if you like it. It's going to make you a lot of money, and you're going to learn a lot from it. All right, let's just dive in. It's like 11 at night. I'm cracked out right now, and I'm just ready to like just drop knowledge. I'm about to drop some knowledge. All right, we're gonna just look at some futures charts, and we'll get. Let me add time frame on this list, because time frames. That's everybody asks me about time frame. My perspective on time frame is crazy, but we'll get to that in a second. Let's just start with how I view the market. So, markets move like this. Now, there's a lot we can cover. The main thing I want to talk about is essentially how they move. This is the one pattern you're gonna need to learn if you want to be successful trading. Okay, stocks go like this. We're gonna assume we're in a bull market, right? They have a deep retracement, a really nice hard move up. Okay, let me just get rid of this. Deep retracement, really fast move up, smaller retracement. We have this called, I guess, like chop phase. We're kind of just chopping around. We'll break some highs, break some lows, maybe move a little bit higher. Okay, this is the classic trap we'll talk about later in the video. Price dumps to this area, and then it skyrockets back up. And then we repeat the process, just like this. This pattern is everything you need to know. Now, when I come in the market, am I actually looking at this pattern? No, but it happens all the time. Happens a lot, happens all the time. All right, I can show you a quick example right here. I just spotted out of the corner of my eye. Right, deep retracement, big retracement. We just didn't really do it here. I guess you call this a deep retracement. Consolidated phase, and we go back up, and then we repeat the process. We keep going. All right. So how do I actually view the market? Now, I view the market in what I like to call layers. Okay, layers. Essentially, you can pull up a volume profile node like this. Okay, and essentially, I don't know why it's not loading down here, but essentially, this is what I trade. This is what I look at in my mind when I'm looking at the market. It's kind of like this. Okay, but I'm not actually like visualizing these points and these arrows and these graphs. I'm visualizing like where are areas where price moves really fast, and where are those edges of those zones where price will reverse, and kind of where are those balance zones, right? So you can see here, we kind of have a lot of resistance here. We have a lot of support here. So in my mind, automatically, I will just draw a zone that kind of looks like this, and then boom. There you go. You can see it kind of lines up with this thing here, right? So I can even take this off. We'll get the same stuff, right? So that's kind of what I look at. I tend to look at like where are areas, like if we're looking at this, where are areas where price is going to reverse? Where are those like common support resistance areas that don't necessarily work 100% of the time, but are almost there a lot, right? And so just by looking, I can already look pretty much this area here. Okay, there's gonna be really like, Jordan, but we went through it right here. We dumped through it right here. I know, but this is just how I'm looking at the market. It's how I view it as a 6-year trader. This is how I look at it. It's completely different than how I used to. So this is what I'm looking at. Now, does this mean I'm just buying support resistance zone? I'm just trading like this? No. But this is what I look at. Now, the other thing I look at and the way markets move is, again, that was a trending market, right? Now, in a perfect world, it would be very, very easy to see a trend look like this and then just buy all these dips, right? That would make trading so easy. And a lot of people draw charts and uptrends and downtrends that look like this, and they say, oh, you just buy in the pullback. You just do this. You just do this. Markets don't look like this, okay? Markets look like things like this, where we just go down and then up and then down and then up and then middle and then up. And then you're like, well, that's not really what you told me. This is like an M or this is a W or a butterfly. We start naming animals, right? We start getting crazy. It doesn't make any sense. So let me break it down. Now, the other thing that we look at is things like this. So we'll draw kind of this kind of choppy phase. This is my favorite thing in the world to draw. Kind of these balance zones, all right? These are areas where we have really good chop, really good support resistance, right? And price likes to, I'll get into retail theory in a second, but price will like to do a lot of things. Like price will love to just stop putting all these people out and then go the opposite direction. It happens all the time. It's really magical. A lot of times this pattern will happen on a smaller time frame in these areas, okay? In an area like this or in an area like here. At these lows of these uptrends, you'll see this on a smaller time frame here. So it'll kind of look like this, right? We'll be in an uptrend. We'll come down, have a lot of consolidation. We'll start to move up a little bit, and people are like, oh my God, I'm going to buy. We're pulling back up, and we're breaking out of this little consolidation area right here. Let me get the breakout. We're going to buy. Oh my God. And then we'll do something like this. We'll just get that extra little stop hunt, screw everyone, and then rip. And that's what the market loves to do. It's their favorite thing. Okay? So that's what you need to learn. That's kind of how I view the market. Now, retracement sizes. We kind of already talked about that, right? If you have a big move like this, and then we retrace down a little bit, and then we start to move back higher, or we do something like this, or even move down a little bit like this, this is all like fake support. I don't even know how to describe it, but this is all just like nonsense. This is like, you know how it's like you can build a house like what's the 3 pig story? Like you can build a house out of like wood, you can build out of like bricks and build out of cement, right? Cement's the strongest, bricks are in the middle, and then there's like wood. It's like this, when we have a small retracement, that's out of wood. If we have like a deeper retracement, this is bricks. Even more deeper, this is like cement, right? Because cement has supply and demand supporting it, right? And you also have, again, if we're just looking at this in a sphere of we're going to take a step back. If we're looking at this as a sphere of an auction, right? And you have your buyers down here, your sellers up here, right? Where's price going to be fair? Let me draw a little Fibonacci out here, all right? Where is price going to be fair? Again, let's say this is coconuts. I want to buy coconuts, okay? I can buy them at 4,600, 4,500, 4,800, right? If I'm a buyer, if I'm a normal buyer, I want to be buying them at a discount, which if this is an auction, I want to be buying it below 4,600 because that is fair. 4,600 is fair price. That is middle. That is where there's an equal amount of buyers and sellers. I want to be fair. So anywhere below this amount, I am going to buy that, right? I'm going to be a buyer. I'm going to get the coconuts because it's at a good deal. And anywhere above that, I'm going to be looking to sell, or maybe I'm going to hold off on buying. That's where time comes into play. We'll get to that in a second. So we look at this as a perspective of an auction, okay? And so when price is up here and we're building the support level, right, we're building this kind of base of quote-unquote demand or support. You see buyers step in. These are what I call fake buyers because they're buying them at a premium, right? Now, in some instances, stick with me, some instances, this is actually more bullish because it's showing us that we have buyers who in a normal market should be buying below the 50% mark or below that kind of fair value mark, but they're actually market buying above. Okay, that shows aggression, that shows buyers, that shows speed, which we'll get to in a second. But most of the time, this is fake support, and you can't rely on that because these buyers are not as strong as the buyers down here because they don't have a real support level in. Like, where are these people putting their stop loss, right? If price just makes a stupid fast move like this, and we pull back to here, and you're buying right here, you're buying right here, well, like, where are you putting your stop loss? Are you just guessing, putting it here, putting it here? Like, let's say this is the low and price is back here and we come down, we go back up. Like, you're not putting your stop loss over down here, right? It doesn't make sense. So it's all just fake. And whenever they put their stop loss in a random place, that makes price goes lower and lower. So then it comes down to the bricks, and then it comes down to the cement. And cement is the hardest kind of base. This is the hardest layer where, you know, it's going to be tough for price to get below it. But if price does get below it, now you have price getting through cement. Okay, what can get through cement? Bears or bulls, right? Only bears and bulls can get through cement, right? So all this, I don't like to call them bears that are buying up here. I don't like bulls that are buying up here, right? They're only going to be buying down here. And so if we have price get back below this low, get back below this area, then these bears are very, very strong because they took price all the way down through 3 houses. It took them through the wood, the bricks, and the cement. I don't know if this example makes any sense, but I hope it does. You're sticking with me. So that's retracement sizes. What does that mean? How does that work? So same exact thing, kind of what I was talking about earlier. If we have a big move like this, we have a small retracement, price consolidates, or even price starts moving higher, we start to come down, do not rely on this support. Okay, I look at this and I say, this is bullshit. This is not real. This is wood. If price came down here and then we started moving up, this is more cement because it retraced. Like it retraced from low to high all the way down in this area. All right, does this make sense? Are you guys sticking with me? Say comment or something. All right, I feel like I'm live right now. So that's the theory. Now, we talked about low volume nodes, retracement sizes, why that's important. I want to talk about speed. Speed. Speed is the name of the game. Speed is how you play the game. You need to have speed in your trading, all right? Speed is by far the one thing I look at the most, okay? If I look at NQ on a 1-minute chart, so how I was trading this account here, just like this. I was looking at speed. Most of the time I look at speed. What does speed mean? Well, it's the price. Let me take you back for a second, right? Let's look at a normal kind of bid-ask area, right? Let's say we have, I don't even know what this is. Let's say we have ask here, and then we have the bid all the way down here, right? Crazy spread. But this is what we're looking at, right? Now, if somebody puts a limit order here, that's not going to move the market. If somebody puts a limit order here, that is not going to move the market. The only way markets move is through market orders. When somebody buys on the ask, and when somebody sells on the bid. That is the only way markets move, right? So remember this. That's the only way markets move, is with market orders. Now, if I'm getting a market order as opposed to a limit order, what does that mean? That means I do not care about the spread. I want to get in now. That means I am so bullish that I'm willing to take a premium of a price. I'm willing to get in higher than what the price actually is, just so I can get in now. Just so I can get in now as opposed to the future. That is extremely bullish. And again, price only moves when you have an aggressive means market order, happen. So when we get a move, when we get a move like this, where price just goes very, very fast, there can still be a lot of people putting limit orders on the ask here. You can have a ton. It doesn't matter if you have 20 or 50,000 sellers that have limit orders here. You have people that are aggressively hitting the ask. Again, it doesn't matter if this is the market. Think about this. If this is the market right now, okay, and we're looking at the market, and let's say you're looking at order flow, and you're able to see that, cumulative in this area, we have, we'll call it 10,000 limit orders to buy. In cumulative up here, we have 100,000 limit orders to sell. 10 times as many orders that want to sell here, and then 10,000 want to buy here, and you see price go higher. What does that tell you? It tells you it doesn't matter. This is really important. It doesn't matter that there's more sellers up here. It matters that they are not as aggressive as the buyers. If these sellers were aggressive, they would be hitting the bid and shorting down here. But they are not. They are passive sellers, which is weak. It doesn't matter if there's more sellers. It matters if the sellers are aggressive or not. And so price ended up keep going higher. Again, I don't know the order flow, but in this example, price would have kept going higher because you have more buyers that are more aggressive. It doesn't matter more, they're more aggressive. They're more willing to buy at a premium, hence pushing price higher. And of course, there has to be at some point more buyers than sellers, otherwise price is going to get stuck at a wall, right? You're just going to have price look like, I don't even know. I can't really find an example. You're going to have price kind of just be stuck at a wall, kind of like this. You can see right here how so many times 889, like 50 area. If price sellers could just not take it lower, right? Because you have a wall of buyers. But we end up going lower because the sellers here are aggressive. They are shorting on the bid, and although you have a lot of buyers, they're not buying on the ask. They're just setting their orders out on the limit. Really, really, really important concept to understand. Okay? I'm going to say that, like, very, very important concept to understand. Doesn't matter if there's more buyers, more sellers. What matters is if they are aggressive. Okay? So, speed. Let's take it back a notch. What does speed mean? Speed means this. If price comes down, and then we consolidate for a while, and then price goes back up, and then we have another example where price comes down, and we just immediately shoot back up, those are two different things. Okay? Again, this is where time is really important. Price, if I zoom out, price in this instance, we consolidate down here. What does that tell me? It tells me that they're not as aggressive as here, right? Because if let's say I'm a buyer, I'm looking to buy coconuts, same thing, and price comes down here. If I am a very aggressive buyer and I want to buy a lot of coconuts, I'm going to scoop that up quickly. I'm going to say, oh my God, this is a great deal. I wanted to buy up here, and now it's all the way down here. I'm going to buy as many coconuts as I can. So you buy it all up, you buy on the ask, you buy with market orders really, really fast, and then price ends up ripping higher. Now this example, same thing, price comes down, but we have a lot of consolidation. What does that tell us? It tells us that there's a more equal amount of aggressive sellers than there are buyers here. Okay, at some point the sellers give up. It could have been passive sellers as well, right? You could have had a lot of aggressive buyers here as well, but there's just a bunch of passive limit shorts here, and eventually they get taken up and then price goes higher. That could have been the case, but nonetheless, you have in this example, more buyers and more buyers that are more aggressive. On this example, you just have more buyers, right? Again, until time shifts, and then they're more aggressive at this point, and then the price goes higher. This example is always going to be more bullish than this example. Okay? This is always more bullish than this example. So, how do we use that in our trading? How do we actually look at that? How do I actually use that? So it kind of relates back to supply and demand, but also not really, right? So I can show you something that looks like this, and we can say, okay, this area here, there's no speed. Price is just chopping around. We're kind of just going back and forth. There's no speed here, right? Whereas right here, you can see price comes up to it. We stay there for 2 minutes. We immediately dump. So this area has aggressive sellers. When price came up here, right, because we got to remember, the sellers in this area, they were putting out passive orders. They were not hitting the bid aggressively because they were saying, I want price to go a little bit higher. And then when price got up here, they were aggressively hitting the bid all the way down, aggressively hitting all the way down. And that tells you there is aggressive sellers in this area. So when price comes back up to that area, it's a good trade, potentially, to see, are we going to defend that area? Right? Are the sellers still here going to defend it? Because remember, for price to get back up to that area, there needs to be buyers. So it comes back up. We already know that there's aggressive sellers. Do they hold it? Yes. And the price ends up going lower. Again, this is short-term trading. This is scalping. Okay, but this is also how markets move. So same thing. Price does the same thing. We come up, and then we had a very fast rejection. You see how quickly we just pushed down aggressive sellers, right? When price got back up to this area, because again, sellers here were not aggressive. Sellers here are aggressive. So in this area, we know that they're willing to hit the bid. In this area, they're not. Price goes up, they get a really good deal, then they hit the bid and drop it down. Same thing happens over and over again. All right? Now, how do we actually use this to our advantage? Well, this is where a lot of traders with tight stop losses get screwed because they think of price as linear. And they'll see like, oh my God, there's so many sellers on the ask at 15.10. I'm going to put my stop loss right above it. But markets don't move like that, okay? There's a lot of times general zones and areas that they like to shorten, right? So same thing here. It just depends on liquidity, right? So again, at this point in time, you have people shorting here aggressively on the bid, people shorting here aggressively on the bid, and then price comes down, and they're still not really shorting here. They give it one more spike higher, because they realize there's still a lot of buyers, right? Look how fast price moved here. We went from this move. This was a very move fast as opposed to like this one, right? You can see like from here to here, how it's kind of slow, very back and forth. And then from like here to here, it's just like straight up, right? So it's a speed. So we know that there's more aggressive buyers here, and there's more buyers that show up. So let the buyers take price higher because they're saying they just want to sell. They not only sell, but they want to sell at a good deal. So if they know there's a lot of buyers, they're going to let them take price higher and then sell at a better deal, right? Does that make sense? It's kind of like if I'm trying to buy coconuts and I know there's not a lot of people who are buying coconuts and there's a ton of different sellers who have a bunch of coconuts to sell, they're going to get in a little bidding war and they're going to keep driving price lower until I decide to buy. Right? Same thing. That was vice versa of shorting. That was more buying. But you guys get the gist, right? It's all supply and demand. So when that comes up and that happens, now you know there's aggressive sellers. And again, these are all based on zones and areas. Because again, they see, like if I'm shorting here and I see there's a lot of aggressive buyers, I'm either going to A, get out, or B, let them take price higher so I can get a better deal. And when you notice that, that's what happens. And the price ends up going lower. Same thing. And this is all happening on a multi-exchange of time frames, multi-exchange of players, right? You have some people who are shorting 10,000 NQ contracts. You have some firms, hedge funds, banks shorting a few hundred, a few thousand. You have some retail traders trading with large amounts like that. You have a whole bunch of different players seeing all this things, seeing all this order flow, and then trading based off it. But again, you have these players who are looking to buy and sell, and if someone is generally looking to buy, they would rather buy low than buy high, right? And so you get this instance where if I know there's a lot of sellers and I want to buy, I'm going to wait to buy because if there's a lot of sellers, price is going to go lower. And then I know I'll be able to get in later at a lower time or at a lower date, right? So that's kind of how I view the market. Now, where else does this come into play? This also goes a line with stop hunt. So I kind of combine it with stop hunt. So you can see, I know there's a lot of sellers in this area, right? Later in the day, it becomes a very, very good shorting area for a scalp, right? Right in this area here. I actually took one, I shorted up here and then shorted up here. And you can see I was buying down here, just scalping. I saw the same thing happen, right? So you need to look at it in the same way, right? But again, these are zones. So if price goes past it, it's like people will draw like support resistance. I hate that this is a dot. Let me just draw this to a solid line. People will draw support resistance, and then price will break out of that support or out of that resistance, and let's say it's automatically bullish, right? But what if let's just say we had a bunch of sellers. Let me redraw that. This will make sense. Like let's say we have a bunch of sellers up at this area. Okay, let's say there's a firm that's looking to sell 100,000 contracts short around this area, and they like this price. They're willing to short at this price. They're not going to short it down here or down here, but they are willing to short and get in at this price. Okay, and then they see through tape or through other vehicles or whatever that there's a lot of buyers, a lot of aggressive buyers. So what are they going to do? They're going to, I'm just going to take all my shorts off the ask. I'm going to let them buy this thing. And they let it buy it so they can go ahead and get short all the way up here. Okay? And then when they're getting short all the way up here, then they're loading up. Then they're saying, okay, yeah, we're just going to let everyone else buy this up. Let everyone who's an idiot and aggressive buy it. And then we're just getting at a better deal, right? I was willing to short down here at 68. Now you're giving me an opportunity to short up here at 50 or 54. I'm going to take that. So it'll take price as higher as price will go as there's enough buyers. Once they see that buyers are selling out, that's when they get more aggressive and hit the ask, right? They'll get more aggressive, hit the ask all the way back down to 68. And then, again, because remember, they're looking to short at their prices only and where they can get liquidity. So they're going to take all that liquidity, bring it back down, and then they're just going to let price fall, right? Because everybody who bought in here is going to eventually sell, and that's going to drive price lower, and then they're going to buy and do the same thing the opposite direction. So when I see price have this resistance zone and price breaks out of that resistance zone, I tend to look at it as more of a short opportunity, right? So when price kind of breaks out here, I'll look to short and add to my shorts for a move back lower. Again, that is not like a strategy I'm telling you to do. That is how I view the market. That is how retail versus institutional trading works. Okay? So, a lot of things covered. But this is what I can do. So when price comes back up, you simply wait for speed to confirm, right? So we're shorting this area. They'll let price go higher. They see there's a lot of demand. Price goes higher. They take their orders off the ask. They let price go higher. They see, okay, I'm going to short here. I'm gonna add on my shorts as price coming down. Oops. Add on my shorts as price coming down. And then, cover their shorts down here. Maybe they add a little bit and then cover some more down here, right? Same thing. Price comes back up and they short in this area. It's all like support resistance, but it's more based off zones and areas. And it's timing of how they're actually letting the traders behave and the traders move. It's no longer like support resistance it's all time frame, right? Because you can be shorting here and there could be a lot of sellers here, but if these sellers notice there are more buyers, they're going to move their orders higher because they'd rather get in short up here than down here. Same thing with buyers. If I am going to buy and I am comfortable buying at 50, 53. Let's say I'm comfortable buying at 53. I get a few shares. Price goes higher. I notice there's a lot of aggressive sellers. They're squeezing price lower. I'm just going to take all my orders off and get filled down here, right? Because my overall thesis, if I'm buying anyways, that price is going to move higher in the higher time frame. So that's what they're doing. It's all the same thing, right? And same thing like this. Again, speed, right? If price is able to spend a lot of time at this area, then it means there are aggressive sellers. It means price is more likely to go lower. Remember, what was the first thing I said? I said we have an example like this, and we have an example like this. Oops. Right? This example is always going to be more bullish than this example. And this example is this one here. This one is less bullish because it shows there are more aggressive sellers that are hitting the bid down here. They drive price lower, so the buyers take their orders off the bid, and they'll buy at a lower point. They'll move their orders down or aggressive buy market orders down here and drive price back up. That's all that's happening, and that's all I'm doing when I'm looking at the market in this way. Right? I'm just looking at a kind of like balance. Where are the sellers? Where are the buyers? Where are the aggressive sellers? Where are the aggressive buyers? And let's take a trade. Let's take an advantage off of that. It's complex, but it's simple. Okay? Now, that's kind of how I look at the market in a general complex. Look at Roku. This is an absolutely beautiful example. Could not have done something better. Look at this. We have just a ton of sellers up in this area and a ton of buyers down here. The amount of times you get to scalp this range is crazy. But if you're playing this little support resistance game and you're buying here and putting a tiny stop loss, and the same thing with the tiny stop loss up here, you're going to get screwed. Now, am I telling you to not use a stop loss? Am I telling you to use a big stop loss? No, I'm telling you how to read the market. I'm telling you how the market works and how I look at the market. And so you can come up with your own edge, your own strategy based off this to trade it and take advantage of it, okay? Because it happens all the time, right? Same thing like here. You could have had a lot of sellers up here. They notice there's aggressive buyers. They take their orders off, and they sell up here because they know they can get filled higher. They bring it back lower. Same thing. It's just a cycle. Same thing happens. And then, so that's basically speed, stop hunts. Talked about stop hunts a little bit. Retail theory, basically went through that. Again, actually, let me go over retail theory. That's kind of back to what I first started talking about, but it goes more in depth about how the markets actually move. So let me break this down, all right? Let me remove this. So let's go back to that first example of how markets move, right? We have that deep retracement first. We have a big upside move. We have a smaller retracement. We have some more kind of consolidative. Maybe we move up a little bit. Maybe we move down. We have the fake out or the bull trap. And then, the bull trap here, the bear trap, and then the move back higher. This is how markets move. Let me explain what's happening. I'm going to make this black. I don't like blue. So, what's happening? Again, what do most retail traders like to do? They like to buy high. They're kind of the idiots. They're the opposite of most people, right? They like to buy once they see prices skyrocket. GME's hitting new all-time highs. I want to buy. So they're actually the idiots that are buying all the way up here. Okay, you don't want to be the idiots that are buying all the way up here. All right, you want to be buying down here when it's low. Most people don't do that. So most of retail is buying all the way in this area. Then what do they see? Oh my God, another bull flag, another classic beginner trading pattern. We get the wedge, the breakout. Let me buy even more. Then what happens? Price dumps, right? This is called the bull trap. They're trapping bulls here. It's a trap. Remember, we only had a small retracement. This is not real support. So what has happened? Price breaks out. We've already made a massive move, right? If we already have a massive move, you shouldn't be buying. You should be waiting for price to come back down here to buy. You should not be buying if price has just had a massive move up. So price comes up here. Then what happens? It's a bull trap. So everybody buys here. Price comes back down. Where do they put their stop loss? Where's the nearest support that they see? Where's liquidity? Right here. You can see all these lows right here, all this equal support, these double bottoms, all this beautiful support area, right, that they think is going to hold. To take price right below it. Then what happens? What do they start to think? They see, oh my God, price is price is breaking support. It's bearish. Let me get short right here. So you have a combination of people who are stopping out of their longs here. You have a combination of new people entering shorts here. You have a lot of selling going on. Where is this going into? Right into liquidity. Right? Right into liquidity. Again, they notice there's a lot of aggressive sellers. You have people who are originally buying here. They notice there's a lot of sellers, so they move their bids lower. Stop everyone out here. You have a lot of new shorts that enter. They load up. Then they start hitting the ask like crazy. They start buying like crazy, and then they take price all the way back up. It's the same thing that happens over and over again. If you're able to spot this, you can make a lot of money in the markets. Now, I'm trying to think what else. So, same thing. This is the bear trap, right? Price comes down. It's all the same thing, right? Again, this is our equilibrium. Price is all the way down here at one point. Now price is all the way up here. You don't want to be buying after a huge move. So when price comes back down, they get shaken up. Then they see the classic like ICT stop hunt pattern, right? They see price do this. Oh, we stop hunted the high. We came back low. It's like the M pattern, right? This is also something that I teach to my students, but you have to look at it the right way. Because if you're doing it like this, you're going to get screwed. Where you have this move like this, right? You have this kind of change in trend, right? Price goes up here. We stop hunt this high, just like this. Right? And then we go down here, we quote-unquote break structure of the support. And then you look for a pullback to get short and then go lower. But the reason this fails is because you're not looking at the higher time frame. You're not looking at the bigger picture. You're not looking this at a sense of, wait a second. We just had a massive rally higher. In the higher time frame, you're not going to want to be buying this. Remember, institutions are buying before the move has been made. They're not buying all the way up here. On a grand scale, like a multi-year planetary scale, institutions are not buying right now at this market high. They're not buying at all-time highs. They were buying down here. They're buying down here. Remember we talked about buying at the bricks, buying at the cement, and buying at the wood? Let me draw a retracement from this low up to this high. Right at 50%. They're not buying the wood, right? They're either buying the bricks or cement. And quote unquote, they did it right at the 50%. You want to be getting at least that or lower. So it's all the same theory. It's all the same thing. Where was I going with this? So that's that. I think I was looking at NQ. Yeah. Right, so this is what you're looking at. I got to zoom out. Okay, so knowing this, understanding this, you can apply these theories to essentially make money. I'm just looking at my notes here. So time frame, basically kind of the same thing. People always ask me about time frame. What time frame do you use? What time frame do you look at? I'm always looking at time frame. I'm always looking at all the time frames. 1, 5, 15, 30, 1, 2, 3, 4, daily, weekly, monthly. Those are kind of the main ones I look at, right? Let me explain something. So this always bursts my bubbles, is when people ask me about time frame and they're looking at a 1 hour chart and they're looking at this and I'll say something like go down to a lower time frame and then they'll go down to a 30-minute like this. Like this is just the same thing, right? Like let me go on two charts here just to show you guys this. So wait, what is this? Oh, I have my thing on. So this is 30-minute. This is hourly. Oh, I don't know. I'm lost. Let me just do like the most recent price action. Like you're looking at the same thing, right? Even if I zoom in on just this section here, versus this section here, like it's the same thing. It's just like using one. It's just looking at larger candles or smaller candles. It's the same thing. You need to look at time frame as relative into perspective, right? I'm looking at time frame in a sense of, okay, like where would an institution be buying? Where is there more bigger buying? Where have we seen buying in the past, right? And I can look at it like this. I can look at a smaller time frame and say, we're kind of in this little balance area, and we're looking at this. Oh, we kind of had that fast move up, that small pullback. We're going to look for that move and then eventually go higher. Well, none of that matters if we just stop under this high, which we didn't. But if we stop under this high, then things get a little complicated. And then you want to be looking at a different time frame and looking at that perspective, right? It's all the same thing. Like we can even look at this. We have this low to this high, right? Just like that. These small pullbacks, after we have a big move up, it's all just nonsense. You don't want to be buying these pullbacks. What do? They take price lower, then they fake them out, dump it one more time, and then move it higher. That's all it is. Just remember, this is at a discount. From this low to this high, this is at a discount. All of this is not a discount. Nobody's buying up here. You shouldn't be buying up here, right? It all goes back to buy low and sell high, which most people don't do anymore, right? Most people just don't do that. But if you're able to do that and learn that in a routine of understanding markets and how they actually move, then this video is going to help you out, and you're going to be able to build an edge in your own strategy around this to make money. Now, do I recommend that you do what I did and start an account with 1,000 and trade based off intuition? No. I kind of did it as like a joke just to see if it would work, and it did. Am I going to like try and grow this account to 1 million and like scale it? No. I think at some point I'll blow it up and be stupid because I don't have an edge, right? You need to be trading with an edge. You need to be trading with an actual strategy, and you can use these concepts around it, right? You can look at things like, okay, where are we in terms of time frame? Where are we in terms of retracement size, right? You can turn these into different things and use that as your actual trading. So that's kind of how I actually look at the market. That's kind of how I view the market as I've been trading 6 years. I no longer spot support resistance or head and shoulders type patterns or things like that. I mainly look at it in terms of a kind of brick, cement, wood situation. And like where are the, which support levels are real, which ones are fake, and where are areas where we're likely to see real buying and aggressive buyers come in, and speed, right? So speed, bricks, layers, cement, and wood, okay? Hopefully that example makes sense. I know it's not the greatest, but I'm hoping it does. And yeah, that's pretty much it. That was a nice little charting session. I think I really explained pretty well how my brain works when it comes to trading and how I look at the market. Hope you guys learned something. If you did, again, please share it. Just send it to someone, post it, like do something. I never really asked that, but I don't know. I thought this was pretty valuable, and I hope you guys learned from it. And if you did, comment as well, subscribe, DM me on Twitter if you're interested in learning more from me or whatever. I don't really care. Do whatever you want, and I'll see you guys in the next video.